I'm Janine Firpo, and in this demo, I'm going to be explaining to you the Morningstar fixed income style box. Morningstar actually has a couple of different style boxes. We'll be talking about the fixed income one here, and then in chapter 7, in the demos there, we'll be talking about the style box for public equities or the stock market. In both cases, you have basically a 3x3 matrix, but what the horizontal and vertical axes mean in the fixed income style box and the public equity style box is different. In this particular case, what we're looking at in the horizontal is the interest rate sensitivity. How likely is this bond fund, this bond or this bond fund going to be affected, and by how much, if the interest rates fluctuate? So we have limited, moderate, and extensive, and these tend to refer to the term of the bond. So a bond fund that is shorter term, that only has 1 or 2 years to maturity, is going to have more limited impact on that fund's value if the interest rates change. A moderate or intermediate bond or bond fund that maybe has maturity ranges of 3 to 7 years or more would be more in this range. And an extensive or a longer term bond that could have maturity that's as far out as 10, 20 years or more will have a lot more sensitivity to interest rates. Because if an interest rate, if you buy a bond today, based on current interest rates, and at some point in the future, the interest rates have either gone up or come down, that is going to impact the value of your bond. It's going to determine whether other people are more likely to want to buy your bond or sell your bond. And so we talk about that more in the book. We won't go into it in more detail here. Just know here that the horizontal line measures the interest rate sensitivity and is a signal of how long the maturity or the duration of the bond is. On the vertical axis, we have the credit quality, and it can start with very high credit quality. And again, US Treasuries are the highest quality bonds, and bonds are and bond funds are rated to show that credit quality. And some bonds and bond funds are known as investment grade, and others are known as non-investment grade, which means that they have higher risk related to them. So a high credit quality is a great thing. It means the bond is more safe and more secure. And as you go down this particular side of the quadrant here, you go to a lower quality bond. Okay, so let's take a look at how this plays out in a couple of specific bonds. First, we'll look at the TIAA-CREF Core Impact Bond Retail, and its ticker is TSBRX. And as you can see here, it is a 3-star fund according to Morningstar. It's a 6.3 billion under assets. It has an expense ratio or fee of 0.64%. It is a minimum investment of $2,500. It is considered an intermediate core bond. And if you look at the fixed income style box here, you can see that this is showing up there. So again, remember that across the top, we had the duration or the sensitivity to the interest rate. So this is in the medium section. It is an intermediate. Most of the bonds in this fund are probably in that intermediate range. And then in terms of credit quality, going from top being the best to bottom being the worst, this is in a medium credit quality. So this one look at this box, once you know what this style box means and what these things stand for, you can very quickly determine something important about that particular bond. If we look at another example, this is the PAX High Yield Bond Investor. The ticker here is PAXHX, and this is a 3-star rated bond in terms of Morningstar. You can see here that the minimal investment on this particular bond fund is $1,000. It's got a higher expense ratio of 9.6, and we are looking at a high yield bond. Okay, So what does that mean? Well, if we look over here, you will see that in terms of credit quality, remember that is the vertical axis, this is very low credit quality. So this is a non-investment grade bond, and we can actually see that play out if we go over and we look at the portfolio tab. If you had watched the previous basics video, we explained all of what's in this particular tab. If you haven't seen it, you may want to go back and watch that. But you can see as we scroll down that most of the bonds in this fund are in the area that is non-investment grade. So these bonds carry a lot of risk with them, which is important to understand. And the fact that this is called a high yield bond is because that risk, you're expecting to get a higher return or a higher yield. So this particular bond is offering, this particular bond fund, excuse me, is offering a little over 4.5% interest per year, whereas the TIA CREF, which is a much more secure bond, is only offering a 1.67 return. So this difference in where these particular bond funds fall on this style box and where they fall in terms of what they hold and what they're trying to accomplish is really important to understand. And this is what I meant earlier, is that not all bond funds or bonds are as secure as some people think they are. So you really want to understand how this works. You can also see that this is a shorter. So here, again, going across the horizontal, we were talking about sensitivity to interest rates and the sort of the duration of the bonds. I said that something in this first box would be shorter in a couple of year range. And we see here that the effective duration of the average duration of the bonds in this fund are about 3.5 years, whereas the average duration of the bonds in this fund are a little over 6 years, which is why they fall in that medium area. So a lot to learn and a lot to be able to see just from these style boxes. That's it for this demo. I hope it was helpful, and thank you for watching.